We start off every show with a summary of kind of what we saw happening in the stock market this week, and I'll share, the chart. Um, and what we have here is a chart going back to 2021. You can see the big run up that we had, and then the drop and what have you. But we just keep going.
Yep.
It's just amazing. And that run that we're on actually started on the day of our show, was the low point in October 27th. And I still think it's amazing, because the one thing that just keeps jumping out at me was that we presented the report from Bank of America about the big institutions, the mutual funds and pensions and hedge funds, and their survey that they do, and they had the lowest exposure to the stock market for the last 72 years, pretty much at the wrong time in the end. But it's also what's fueling this, right?
Yep.
I actually just read this week that there's $6 trillion in money markets and those types of things that individual consumers have put in, and it actually grew $1.5 trillion. And so basically, as rates came up and the market wasn't doing well, people were moving into money markets, which made sense to a certain degree. Obviously, it was a mistake in the hindsight, right? Because we've had this huge run up. And so I think what we're seeing here is this kind of money coming back in, and this fear of missing out and what have you. And the power is there. There can still be some hiccups. So this week, we had a 1.6% down day on Wednesday. It was the day that the Federal Reserve came out. And the night before, Microsoft and Google had both reported their earnings and revenues. They crushed both of those numbers, but some of their forward guidance was a little bit soft. More importantly, the market seemed to be looking internally at Microsoft's AI revenue and Google's ad revenue, and they weren't as excited about the growth there. I don't know. I think it was sort of one of those days where the market was in a bad mood in general, and so those stocks got sold off a little bit. And versus what happened last night, right? Last night we've got Meta, right, who reported. Look at that; it's up 21 point something percent. And it's actually, because it's already a big stock. They're possibly going to have the biggest one-day move in market capitalization in history.
Yeah.
Which is kind of incredible. So they reported last night. Market's obviously in a better mood. They said the right things, talked about AI. That's a hot subject to talk about, certainly, and whatnot, too. And so look at that motion. Again, this is going back to 2021 also. Had the big drop and some big, bad times, but really moving up nicely.
Yeah. Billions of dollars were created basically overnight.
Yeah. What was it? Zuckerberg, maybe $14 billion of growth today, something like that,
he basically
right?
made 14 billion overnight.
That's pretty incredible. So that obviously he lost a lot too in that downturn. He had to suffer through some of those things. And the other one that reported last night was Amazon. They're up a little over 8% today. But again, if you look at that, it's still a pretty big move, right? I mean, individual stocks move more than the overall market in general. There's more volatility, but that's a pretty good move. And so the thing that struck me was that yesterday when I was doing the video for the daily video that I do for the market, I was talking about the good earnings that came from this, and I was wondering if they were going to continue to go, and if it would drive the market, right?
Yeah.
Because usually it would. And so the market is up over 1.3% today. But the thing that I was worried about was that today in the morning, before the market opens, they report the jobs, right, for last month.
And the thing to remember is that Amazon and Meta make up 5% of the actual market weight cap of the S&P 500, so they have a big push.
Yeah, so I mean that's one of the nice things about owning the indexes, right? We don't own Amazon directly. We don't own Meta directly. We'd make more money potentially, right? Because it's up 20% instead of being up 1.4-ish on the S&P. However, we also wouldn't have. I think Meta had one day after an earnings report, or one short period where it dropped like 40%. I believe in 2022. So that's why we don't do individual stocks. It kind of goes both ways. But these are big stocks. They matter, especially for people that buy indexes like we do for the most part, or at least market cap weighted investments, which just means that these big companies have more impact as far as that goes. But Yeah, but the jobs report came out this morning, and I was afraid if it came out really high, the market would kind of sell off, and we'd lose whatever momentum was coming from these good earnings reports from Amazon and from Meta. But then jobs report came out hot. It was 185,000 expected, and it was 353,000, I believe, was the actual number of jobs created in December, according to the Department of Labor. So normally, at least in the past, the market kind of sells off when it gets too high.
Yeah.
Because this is worry. It's like it's too hot. It's going to create inflation, and we're going to end up with the Federal Reserve either not lowering rates when we think, or even raising rates is what we used to worry about, right? But I've always had this contention, and maybe the market's finally catching on because the last two times we've had a hotter job report, the market hasn't sold off, is that the number one thing we have in this inflationary environment is a restriction of supply. The demand has grown and the supply can't keep up. Because this week they announced that there was 9 million open jobs, which was higher than expected. It was 8.7, right? 9 million open jobs, and it was 11.4 at one point, the highest point. So it's down from that. But if you look back historically, I think the average is around 4 million open jobs over the last 15 years. So there's a lot of job openings. And what happens is that these companies are putting out these, job postings because they have demand.
Yeah.
Right? I mean, they wouldn't be doing it otherwise. And so they're trying to meet that demand. And if they can't meet that demand, then it starts to become competitive, or we're going to hire people, we're going to pay more. That is an inflationary spiral. When you see a whole bunch of people taking jobs, that changes that dynamic, right? And it starts to create more supply, because the bigger restrictions that we're having aren't in the goods area like we were during the pandemic. It is in the services area, which takes people. So I think more jobs taken, and basically 353,000 jobs were taken, the better. And it does a couple things. Number one is it kicks even farther down the road, again, the concept of recession.
Yeah.
Right? Even the concept of soft landing is starting to be challenged now. They're starting to talk about no landing. The market's the economy's going to continue to roll. And so I think that, again, you look at the second half of last year, gross domestic product at 4.1%, inflation on core inflation with PCE dropped fairly consistently all the way through the second half of last year. And unemployment is at 3.7%. I mean, some of these are lagging indicators, right? So got to be careful with that. But the stock market is not a lagging indicator. So if we go back to looking at the S&P 500 here, look, I mean, the market is telling us that things are going to be okay economically. And the thing I look at, see, the Federal Reserve has about a 3 to 18 month period before their changes have impact, right? On average. It's a little soft number, to be honest. It's hard to tell some of these things, but the stock market is about 3 to 18 months ahead, right? So the market is expecting rate cuts, right? Or it was. And if you look at it, the stock market is saying why. I would be looking, if I was the Federal Reserve, at one of the indicators, of course, something like the S&P 500, which is in the leading economic indicator. When it starts to soften, right, go sideways, starts to fall, that would be some time period where I might consider cutting rates, because of the fact that it's roughly the same time frame. It's saying 3 to 18 months from now things are going to slow down. I got to do impact, rate cuts, which take 3 to 18 months to have an impact. Some of these numbers don't match up perfectly, but you get the idea. So looking at some of the things that are lagging indicators, you have to be careful with. But overall, unbelievable, really. I mean, the market continues to go up, and the thing is that, and I've said this a couple times, I'll say it again, the best run, 5-year run in the history of the stock market was the dot-com, 1995 to 2000. We have artificial intelligence now, very, very similar to me, right? I mean, has huge potential impact, probably going to be really crazy stupid for a while about it, and companies that shouldn't be running will be running, just the same thing. It always happens. I talked about Detroit in the 1900s. It was 2,000 car manufacturing. Anything that's the hot thing goes nuts for a while. It's sort of that tulip mania. And so you do have to be a little careful with that eventual washout, but it can rise the whole market dramatically. The second best, 5-year time frame in the history of stock market was the Roaring Twenties that came after a pandemic, right? We have both.
Yeah.
So I'm not saying it's going to continue to go forever, but you'd be surprised how far these things can go. I've been through this before, so taking profits when things are still flying upwards, I probably wouldn't at this point.
Yeah, and with AI, it's still early days. You're not
Oh
seeing a
yeah,
lot of IPOs with AI like you
nope.
did with the dot coms. You're not seeing all these small companies coming out. It's largely the big, large companies are
Yeah.
still there.
Yeah, but if it follows pattern, we will. Maybe 6 to 12 months from now,
Yeah.
we'll start to see some of these dot coms. Usually it starts off with the legitimate ones. And then if we look at the dot com scenario, it gets into the, bingo.com that told that story a few times.
Yeah.
That's when you know you're getting towards the top, right? So anyway, it's an interesting time period, and you have to be kind of aware of what's going on with all the money on the sidelines. The Federal Reserve, stopping raising rates, at least potentially lowering rates, combined with artificial intelligence and a pent up demand from the pandemic. It's a crazy time frame. So it's something to really watch for here, and I think it could be a good thing as far as that goes. But if we look at kind of what has happened here with the jobs report, just historically, I mean, this is a pretty interesting report. It goes back to 2020. You see that big red? That was actually a huge number of jobs lost, during that quarter for the pandemic, for the first quarter, and it took a long time to recover from that. Certainly, and you can kind of still see unemployment was up there in that 8% range, back then, and it dropped down to actually 3.4%, right, which was kind of a historic low. I think it tied a historic low. Prior to the pandemic, we were roughly around the same spot.
Yeah, anything sub 4 is Fed's quite happy with that.
Yes. Yeah. They consider full employment at 4%, right? So 4% of the population is on unemployment at any one point in time or less. They're not going to worry about that as far as that goes. That's kind of how it works. Whether that's good or bad, it depends on whether you're employed or unemployed as to how you look at that, obviously. But and this is broad. This is across the whole U.S. There could be sectors that are doing quite poorly and sectors that are really, really hot, right? That's
Yeah, like if you looked at the actual breakdown of the jobs report, mining and logging actually lost, jobs during this period.
Yep.
So you could have an industry that's kind of in a small recession in a sense.
Yeah, exactly right. And because of the pandemic and the way that we shifted, we went from, hey, we just generally, before pandemic, normal spending to, hey, we're buying goods because we can't do services at all. And now we bought all the goods we want, and, we're seeing kind of softness in the goods area, and we're going to do service things that we couldn't do before.
We're starting to actually see a resurgence in the manufacturing.
Yeah.
Manufacturing and construction both were hiring, and their kind of productivity indexes are up.
Yeah, we saw the manufacturing report that came out this week showed more strength than we've seen in the last 3 years. So, that's starting to pick up, and I think that's what's going to happen, right? We're going to even back out. We all went to Home Depot and bought things for our home, and we don't maybe need as many now, but slowly but surely we'll probably be going back to do that, because things wear out, new things and what have you. So you have a lot of job growth. You have growth of wages that are going faster than the core, inflation rates right now. That's got to make people feel good. We are seeing some really big upticks in consumer surveys.
Yeah.
I don't put a lot of emphasis on consumer surveys because I've seen them go very negative and they still spend money. It's kind of funny. So I really look at the spending because that's the actual thing that matters, not what they say at a survey. But the surveys are really, really picking up. So I guess that's hopeful, right?
Yeah.
And people are looking at that. Let's look at what's happening in terms of the rates. And for the it looks like we're kind of in the way of this, but I'll read it. I'm sorry about that. But so a month ago, for the March meeting, it was 79% chance of a rate cut, right? 1 month ago. Now it is a 21% chance.
Yeah, it's basically flip-flopped.
Yeah, exactly, almost exactly. And so what the market was anticipating things softening, slowing down. Again, you raise rates this much, something breaks, things slow down, what have you. That's not happening, right?
Yeah.
And so the Fed has been pushing back against this March one quite a bit, and it looks like the market's capitulated. We had some rockiness as that we went through that, but I think the takeaway here is that we don't need to worry quite as much about what the market thinks versus what the Fed's going to do up to a point.
Yeah.
Right? If the Fed is continuing to, really keep rates going when there's a lot of evidence that they shouldn't, we're seeing the stock market come down and we're seeing all these things, that's when we got to worry about the Fed going too far. I will say this Fed seems to get an inertia, right? So they had rates at zero, they were buying all these bonds, and lots of people were saying they should stop, they should raise rates because inflation started to come in really hard. And they actually kept going, and they really took a long time. They first stopped buying the bonds, and then they started raising rates, but it was like a 6-month period, and inflation continued to run. And the fear is that they would do the same thing on the other side, right, where they keep rates up too long and cause problems from that. So just one more slide here on what's happening. So the rates for May, okay, May 1st would be the meeting after the March meeting, it was a 92% chance that there was going to be a rate cut by May. Okay, so it was, if it wasn't going to happen in March, it's going to happen in May for sure. That has now dropped down to a 72% chance.
Yeah.
So still pretty high, but I wouldn't be surprised to see that deteriorate like in flip-flop like March has. The Fed has been pretty steadfast in their interviews talking about doing rate cuts in that kind of June through September timeframe.
Yeah.
So, we'll see. May's a long ways off in the world of, economic data.
Yeah,
right?
we got so many months of just inflation, jobs.
Yeah, we've got the PCE reports that'll come out, right? The jobs reports, the factory order, all these things that they'll look at. The S&P 500 and what is it doing, those types of things too. But I did think, again, one of the things that I thought was a theme for this particular Fed meetings coming up here, they're not being as aggressive in their conversations or interviews or question and answer periods or what have you about trying to push the market down. Honestly, prior to November of 2021, I'd never heard a Fed be as aggressive against the markets as they were. They were trying to talk down the markets, trying to talk the bond market to going up into higher rates, partly so they probably didn't have to do as much in terms of their rate changes. But now, I think they are fighting some deflationary potential pressures. If you take the last 3 months, of the PCE core, it was 1.5%.
Yep.
That's below where they want to be. So I think they're okay with letting things run. And I'll bet you they're pretty happy with this jobs report too, again, because, they have a dual mandate, 2% inflation and full employment, right? And so this helps that full employment portion, but also it kind of satisfies some of the supply. And they've talked about that in the question and answer too. So I don't know. This is a great time frame. It's really fun after all the maneuvers we've gone through over the last several years. Even last year's 10% drop. The market is kind of a funny thing. Really, the best place to be is in an even keel. But if you can't accomplish that, at least enjoy the good times, because that doesn't always happen. I get a lot of people that seem to really kind of lock in on the bad times, and then the good times they don't want to accept them because they're kind of protect themselves. But to become a better investor, you got to get in the middle. That's why we kind of present the positive a lot to try to get people into that. But right now it's pretty positive, so enjoy that, and just from a feeling standpoint, and be glad that you're in, because a lot of people aren't. There's $6 trillion sitting in money markets. That shouldn't be there in hindsight, right? So it's nice to be in. So congratulations. So anyway, that's the summary for this week. Really enjoy going through this with everybody, and look forward to doing it again next week.